UnitedHealth Group just posted $112 billion in quarterly revenue, practically flat year over year, yet their net earnings surged by an astonishing 61%. How does the firm engineer a massive profitability spike while simultaneously shedding over 1.2 million covered patients? Or are most analysts ignoring a major growth ceiling? Consolidated revenues ticked up a mere 0.4% to $112 billion. Headlines are screaming that healthcare demand is stalling. Investors often view such low revenue growth as an alarming sign of market saturation, especially when consumer inflation sits at 3.5%. But beneath the surface, the company is quietly running a masterclass in corporate profitability. Net earnings attributable to shareholders reached $5.48 billion. Diluted earnings per share hit $6.04, beating past performance. Management isn't focused on blindly chasing patient volume anymore. They're aggressively extracting maximum yield from the exact same revenue base. The balance sheet reflects this newfound stability, holding strong with $309.73 billion in total assets. The market consensus must decide whether to penalize the business for stalling top-line momentum or reward it for elite cost control. To understand how they generated that yield, you have to look at the exact customers they serve, or rather the ones they aren't. During the quarter, UnitedHealthcare lost 525,000 members sequentially across its core health insurance plans. On top of that, their medical care subsidiary, Optum Health, recorded a 5% revenue drop directly linked to serving 700,000 fewer value-based care patients. The financial crowd is entirely captivated by this combined contraction of over 1.2 million covered lives, assuming it indicates a structural loss of market share to competitors. However, this is actually a deliberate pruning of highly unprofitable medical contracts. The firm proved the brilliance of this move by driving its gross margin up to 20.8%, a significant expansion from the 17.9% gross margin reported in the prior year. They achieved this by compressing the critical medical care ratio down to 86.7%, meaning they spent significantly less of their collected premiums on actual patient treatments compared to the 89.4% medical care ratio seen previously. Direct medical costs were strictly contained at $75.36 billion. By systematically shedding expensive, low-margin lives, the business expanded its overall operating margin to a robust 7.1%. Management is proving that focusing on margin quality over pure patient volume is a highly effective operational strategy, refusing to discount services to artificially inflate the top line. But squeezing out medical costs is only half the equation, and the other half is starting to look surprisingly expensive. The operating cost ratio actually worsened slightly, coming in at 12.7% compared to the 12.3% operating cost ratio recorded last year. Most observers view this uptick as bloated corporate overhead. Yet, this elevated 12.7% operating cost ratio is completely tied to an aggressive technological pivot. The company just appointed a former banking executive as its new chief AI officer and confirmed a strategic partnership with Anthropic. They are spending heavily on physical infrastructure, like vast automated data centers and specialized software integration, aiming to optimize their $75.36 billion in direct medical costs by eliminating administrative friction. The institutional crowd is betting that this short-term capital expenditure will eventually transform into structural margin expansion by automating costly everyday tasks. This is exactly why a portfolio can feel stagnant right now. If you only look at surface expenses, you miss the underlying investment securing future dominance. If they successfully execute this technological rollout, the firm will drastically lower their employee headcount requirements and reduce the time it takes to process everyday insurance claims. This is where the real structural advantage lies, as management sacrifices a tiny fraction of their 7.1% operating margin to build an unassailable technological moat. This massive tech pivot is only possible because of the underlying financial cushion protecting the entire enterprise. The business generated a staggering $11.1 billion in operating cash flow for the quarter. This exceptional liquidity covers their reported net income by a multiple of 1.9 times, meaning the actual cash moving through the door vastly outpaces their accounting profits. Such a high multiple proves their earnings quality is exceptionally strong, beyond clever accounting tricks. Zooming out to the 6-month window, implied free cash flow reached a massive $18.4 billion, supported by disciplined capital expenditures totaling just $1.56 billion. This overwhelming cash engine allowed management to rapidly deleverage the balance sheet, bringing their total debt down to $73.33 billion. Consequently, the formal debt-to-capital ratio improved to 41.2%, down from a 44.1% debt-to-capital ratio a year ago. This rigid balance sheet protects the firm against market volatility. Furthermore, the company used this liquidity to heavily fund shareholder returns, executing $4 billion in accelerated stock buybacks through mid-July. By purchasing their own shares so aggressively, management established a firm valuation floor that effectively offsets lingering anxieties about that flat top-line growth. They also delivered $4.09 billion in dividend payments over the last 6 months. Cash and short-term investments closed at $31.47 billion, ensuring absolute solvency regardless of economic conditions. All of this financial maneuvering leads to the ultimate test of their operational confidence heading into year-end. We are currently navigating a sluggish domestic macroeconomic environment, with annualized US GDP growth slowing to 2.1% and the Federal Reserve holding interest rates firmly between 3.5 and 3.75%. Retail sales are up 6.7% annually, and the US dollar index currently sits at 101.11, reflecting ongoing global uncertainty. Despite this economic slowdown, management confidently raised their full-year adjusted earnings per share guidance to a range of $19.50 to $20. This upward revision in the adjusted earnings per share guidance projects operational confidence and signals high visibility into their healthcare utilization trends. One major piece of risk was recently removed when a judge completely dismissed a defamation lawsuit, clearing away public relations overhang for the $309.73 billion asset powerhouse. This brings us back to the ultimate puzzle of how UnitedHealth Group is engineering such a massive profitability spike. The fundamental truth is that the business has transitioned from a volume-gathering machine into a precise margin optimization engine. By aggressively managing medical costs, integrating artificial intelligence to reduce administrative burdens, and deploying $4 billion into share repurchases, the company is proving it possesses the ultimate pricing power required to outpace broader economic pressures. Do you think this aggressive shift toward AI and cost-cutting will compromise their quality of care in the long run, or is this the perfect blueprint for modern healthcare dominance? Let me know in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.